Welcome, everybody, to the SNN Network Summer Virtual Event. I'm your host, Robert Kraft, and I'm very excited to introduce our next virtual keynote for today. Gentleman joining me right now is Mark Jones. He is the fund manager at Pragmatic Capital Management. I recently had Mark on the Planet MicroCap podcast, and I've never met anybody that is so passionately the contrarian investor as Mark is, and I had to have him on here to do a keynote presentation on what he has going on at Pragmatic. So with that, Mark, take it away. Thank you for joining us.
Yes. So first of all, thank you very much for having me as a guest. I'm really looking forward to speaking about our unique approach to investing, the Contrarian approach that we have. It's going to be really unconventional, but I think that it'll be informative and engaging to the audience. And I'm just looking forward to, getting into it. Okay, so with that, let's get into the presentation. And in this presentation, before we get into the details, of course, we've got 30 minutes, seems like a lot of time, but of course, time flies when you're having fun. So just to give, an overview of the topics I'll cover, first I'll cover Pragmatic Capital, give our background, who we are, give my background, who I am. And then actually the sequence of events will be a little different in that I'm going to move into our results. I have more of a systematic approach to investing, and I believe that our results are validations of our unconventional approach to investing. So I think, before going into, our investment approach, philosophy, strategy, process, I think it helps to really bring some context into, how well we've been able to do since launching, just to kind of give, some rationale for, why, one should, take an interest in just our approach and what we're doing. So kind of validate our point of view, if you will, because I will be saying some things here that are, pretty unconventional, but, I think it's based on sound logic. So we'll go into the system validation, as I call it. And from there, we'll go into our unconventional thinking, covering our approach, philosophy, strategy, and process. And each of those components are really differentiated, but highly related to each other. And I'm looking forward to getting into that. And lastly, I'll just show a slide with, what I call the materialization of the strategy. And that's really going to be, just contrarian case studies, a basket of, stocks that we've been invested in that have been found using our unconventional approach that I would like to share with you. So with that, let's move into, the background, into who we are. So I regard Pragmatic Capital as a hedge fund of the future. We launched in May of 2019 with a clear mission of being the greatest compounder of the greatest compounder of capital on a global scale. And with that, in order to lay a great long-term foundation, we remained in stealth mode since launching so that we can really make sure that the process is optimized, the strategy is optimized, so that as we brought, the opportunity back to the world, we can have some, validation of our results. So we've only had a seed round, and now we're coming up out of stealth mode. And so a little specifically, as was alluded to in the beginning of the presentation, we employ a highly unconventional approach to investing. That I believe is the antithesis of the conventional approaches that have shaped active management for decades. And I'm looking forward to getting into this. So specifically, we employ a hedge contrarian investment strategy supported by deep economic research, primarily microeconomic research. We manage a concentrated portfolio of about 12 or so contrarian investments that we believe possess clear support for asymmetric risk reward characteristics. That we believe is the holy grail of investing. So each investment is fully hedged with stock options to create an additional layer of asymmetric risk reward by keeping that exposure below 20%. And we're really proud of that. And that's something that, we've worked really hard on to optimize, to be able to have this, return potential while being really aggressive actually with the risk management. And so our high conviction approach to investing is evidenced by our compensation structure. And I'm bringing that up to really just show as another piece of evidence that, we invest with high conviction. And that is manifested in our compensation structure where we do not have a management fee. We waive the management fee completely. And our performance fee is based on outperforming the S&P. And so this just provides some context that, we really mean business when we say, we're contrarian and we are after, those outsized returns to build a hedge fund of the future. So, we like to put our money where our mouth is. So with that, a little bit of background about myself. I'm a huge fan of Andrew Carnegie. He has a quote, "My heart is in the work." And that really resonates with me. I love investing. I'm deeply passionate about, utilizing this passion for investing to help others. I have a different approach to what investing is. I view it more as a highly complex puzzle that operates at the intersection of business, psychology, and everyday life. And this is truly my life's work. Prior to launching Pragmatic Capital in 2019, I ran a research firm that provided Contrarian research, deep research reports to a group of hedge funds. And so that was a research business that really helped optimize the research process to be, really efficient at identifying these contrarian investment opportunities. And we've actually got several of those archived research reports on our website, which I will give you later. Prior to that, I actually ran a beta hedge fund that really was Pragmatic Capital 1.0. That again was just a way to put the strategy to the test after I finished business school. And overall, things have gone really well, and the firm has done really well, which I'll get to. I'm a CPA by training, and I hold several business degrees, bachelor's, master's in accounting, MBA from Carnegie Mellon. And so with that, I know I moved through that a little bit quickly because I really want to get at, the results and the thinking. And so again, I believe that, giving some context to, how effective we've been at employing this unconventional approach to investing, I think brings some context to, why, this unconventional approach may actually be useful. So we believe that we have an investment system, which, there's a philosophy that shapes the strategy, which guides the process, which yields results, which we study to update our thinking of how the market actually works. And since launching in May of 2019, as you can see, we've significantly outperformed the S&P and outperformed the average hedge fund according to the Barclays Hedge Fund Index by a wide margin. And that success has continued in 2021. I strongly encourage you to listen to the podcast that I did with Robert Kraft, talking more about, how we bet on America in 2020 and things of that nature. But this, I believe, is, this provides great validation for our approach to investing. And I'm looking forward to getting a little bit more into it. With that, we're going to get into the unconventional thinking, our investment approach. This really shapes how we go to market, if you will. The approach, sets off a sequence of events that, I frequently say, it's almost impossible to get to the right destination on the wrong road. So with that, your approach is critical, and we have a really unique approach. So we employ an independently developed systematic approach to investing rather than attempting to carbon copy, our favorite investors' approach. Some people love this investor, that investor, that investor. And, I'm not saying that that's a negative. However, we employ an approach where we're trying to, build something from the ground up because we believe that, investing is really a cognitive activity where you're gathering information, you're thinking, you're processing. And, we all have unique ways of thought. So we, employ, this in our strategy, in our approach. And so, instead of attempting to force the market to accept our approach, we design an approach to accept the market as it exists so that we can capitalize on what we believe is just the natural order of the market as it is, specifically the secondary market, which, I believe is very different from, private equity markets, venture capital markets, things of that nature. And as I said before, it's a systematic approach where one component is interconnected with another component. And this has served us, really well. And I look forward to getting a little bit more into detail about, each component that, we have here in our pragmatic system, as I call it. With that, I'm going to move into our investment philosophy, which, is constantly evolving. I'm on a quest, if you will, a lifelong quest to understand the market, to understand market participant behaviors, to understand cause and effect and sequence of events and things of that nature. So that learning is never done. However, an investment philosophy has been developed based on observation, be it statistical analysis of, plenty of historical data of, major winners and major losers to see relationships between them, but also as each day passes, updating that philosophy as more observations are made and tested. Our philosophy is really based on leveraging pattern and process recognition. We believe that, stock prices are the output of a continuous process that frequently exhibits predictive patterns. So this belief is supported by, again, extensive quantitative and qualitative empirical analysis that is continuously tested and updated. And overall, our philosophy is based on the following realities. We believe that the market's auction-based system has a pervasive impact on stock prices over any time frame, as the process is continuous. It's just kind of a never-ending timeline, if you will. And there's a lot of value in approaching the market from this angle. It's not everything. However, it's a really critical part to put some context to how economic information will be received. Additionally, we believe that economic data is only a signal in the market pricing process. It is not, this is not a calculation, if you will, where you have this, revenue beat or, revenue growth or earnings growth, and that's just the end of it. No, I believe that there's significant evidence that kind of, sets the first wheel in motion or knocks down the first domino. And overall, we believe that desire to participate is the single greatest driver of stock price movement and most overlooked. And I'm looking forward to, speaking about that, a little bit more. But what that, really, I think a clear example of that is, risk on, risk off, those type of movements where, the market moves in these, kind of, broad strokes, if you will. And there's a lot of herding, a lot of following, a lot of, trend, technical investing that actually happens. And we believe that that's what a trend actually is people following each other. And if that happens enough, that actually changes the stock price level of the stock. And so we believe that just significant evidence shows, and our operating assumption is that if a stock is not, quote unquote, working, there's going to be selling pressure. And if a stock is working, quote unquote, there's going to be, buying, pressure, I guess, on the opposite side. And kind of knowing that this is how the market behaves in this reactive way is a critical part of our philosophy. And so overall, we believe that the market is more of a reactive system than a predictive system. And there's so much more that I can say on that. But in the interest of time, I'll leave it there and move on to, the next part of our unconventional thinking, our pragmatic system, which is the investment strategy. So again, we're contrarian, but that's more of, how we're regarded, because we, every time we invest, we're going against the consensus view. We don't do that just because we love to oppose people and we're argumentative and things of that nature. We believe that is, if you're investing in a situation where desire to participate is low, what you're going to see is a stock that has been, materially impacted by that. And, no one wants to catch a falling knife. Or if desire to participate is really high, a lot of times people are just buying because the stock is going up. That can create an opportunity to short, so long as the economic substance is there. So with that, we always go against the herd, because that's where you get the biggest ROI when there is when there's economic data that is the opposite of the direction, if you will, that sentiment has gone. And in addition to that, we include dynamic hedging to really create that asymmetric risk reward that we believe is the holy grail to investing, so that we either win big or lose small. And of course, investing is really about probabilities and payoffs, and that's what determines your success over time. And so, of course, there will be some situations where we do not make a return, we're wrong. So as long as we can kind of structure the trade where that's in that case, how much we would lose is capped. You really create these asymmetric payoff situations, and that has been how the situations played out for us in the marketplace. So this strategy is designed to, of course, capitalize on our unconventional philosophy in order to realize our objective of market beating returns. And every single investment we invest in has to be a contrarian investment. We are really, 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 kind of orthodox even in this approach to making sure that we're contrarian and we have a concentrated portfolio of high conviction investments. A little bit more detail on, the strategy in action. So, again, we construct a portfolio of about 12 or so contrarian small to mid-cap stocks that are fully hedged. We want to make sure that the way that we approach investing is not just successful, but it's scalable. We want to make sure that the market cap, that the liquidity of the stocks that we invest in makes it such that as the assets under management scale, we would still be able to invest in these same situations Now, the size of the portfolio is going to, expand over time, never get to the level of 50 positions or even 30 probably. But of course, as you have larger AUM, you have to have a lower allocation compared to when it's smaller. But if you're in stocks that have a $500 million market cap or a $5 billion or $10 billion market cap, there's a lot of liquidity and there's a lot of room for you to have, such a situation in your portfolio. And that's, us thinking about the future and building a foundation where we can scale in that manner. And so overall, we identify stocks that we believe have great potential to, generate outsized returns, market beating returns over a 6 to 12 month period. That doesn't mean that we're going to sell in 6 to 12 months, but we would need a catalyst to occur, within that time frame. And we actually like to time the initiation of the investment close to the catalyst, which will be an earnings call. And I'll speak about that more when I get into our actual research process and to how we go from, no investments at all to having a fully constructed portfolio. And we employ the same, 4-step process each time. And I'll get to that, in the next section. Again, we have significant hedging in the portfolio to keep net exposure below 20%. And just an example, if we purchase 200 shares of a stock and we're going long, we're going to purchase 200 put options to protect that investment. And we're going to have a strike price that's slightly below, the current stock price to really, keep the hedging cost in control. And this only works if we're right much more than we're wrong, and the payoffs are, of the magnitude that we're expecting. And as you saw with our, returns to date, that's gone really well. And so I have this, chart on the right, just to kind of as an illustration that, we're not looking for a needle in the haystack, actually. If you look at, if you were to disaggregate the average return of stocks in the market, with certain parameters, you'll see that there are many stocks that are material outperformers and material underperformers, on the short side, that if your approach to investing is based on stock picking, then it's kind of the reason you exist is to be able to identify these material out or underperformers if you're long or short, before they ultimately become that material outperformer or underperformer. And these are annual, returns that are the underlying statistics used in this chart to the right. But it just goes to show there's actually a wide target to hit. If you take this approach to looking for stocks that exhibit patterns, such that if the company does well, there's going to be an outsized return. And so, with that, this is the strategy that we go into the market with. These are our operating assumptions. And again, it's gone really well for us. And I'm sure, as you can see by now, this is really unconventional. In order to be contrarian, in order to, and I guess I'm going to kind of give away a little bit of the next section. But I will say this: if you're investing in a stock that's down materially, by definition, that means that the average market participant is not, buying that stock at that level. Because if they were, then there would be more support and the stock wouldn't be down 50, 60, 70%. And likewise, if you're shorting a stock that's up 200, 300, 400%, by definition, the average investor is not selling that stock; they're buying that stock, because that's literally how the price is realized. It's the last price, and it's the equilibrium of supply and demand. So that's a major difference for us. Is really, you can say, it's our cost basis. The price that we're entering in is not the average price that even the average shareholder of that stock has obtained, because they either purchased it before the sell-off or before the big run-up, which is great, but on the short side not so great. However, or that investor purchased the stock kind of, if it's long, they purchase it after the catalyst, and you really miss a lot of gains there. So we want to make sure that we're really timing it right to kind of get at that inflection point, and we've been really successful at that, using our 4-step research process to identify these stocks that exhibit certain patterns, which must be related to a company that's actually a great company that's having a difficult time in the market for several reasons, or it's actually a poor company that's really loved for several reasons. But we believe in both cases that there's a catalyst that's coming that the market is not anticipating, because we believe that the market isn't really a predictive structure. It's more of a reactive structure. With that, we're going to move into the research process, and this is going to go in depth on some details into what I mean when I say that we do deep microeconomic research And this is something that you can only do if you have a concentrated portfolio. You cannot take a research process like the one we have and conduct it across 50 stocks, 40 stocks, 60 stocks in a year and have a turnover of 50%. And which means you're looking at, if you have 50 stocks, on average, that means you've had 75 in your portfolio, throughout a year. You just cannot employ this type of deep research. And if you could, it also wouldn't make much economic sense because you'd be doing this deep research for, a position that is, 2% of your portfolio. Just the economics aren't there. So I think that even having that modern portfolio management approach prevents one from being able to employ a contrarian approach to investing or a deep research approach to identifying opportunities, which is an advantage for us. So our process is designed, again, to identify stocks with current prices that are likely to experience a material change based on our market pricing theory, which is really rooted in desire to participate. So we take a more conceptual approach to building an understanding of stocks and companies because we actually believe that they are distinctly different entities, if you will, that have their own unique drivers. They're related, but they're not identical. So we want to build an understanding of the stocks and companies to identify a stock's market pricing components. What does the market care about? What is driving desire to participate in this stock, just from a subject perspective? And it's going to be different for each company. There may be general overlaps if you're talking about a Pinterest or Snapchat, but you have to really get into what does the market show it really cares about with regard to this specific company. Of course, it's going to be revenue and earnings. However, what portions of revenue? What are the key drivers that the market really cares about? And importantly, designing a research process that kind of is able to have a really informed point of view on the drivers of revenue and the drivers of profitability so that we can quantify our research and be able to have forecasts that we believe are more accurate than Wall Street's, because that's going to be a major catalyst for us. So we essentially know we know the nature of the information we need and how to distill meaning from it. So, we have a very efficient approach to effectively identifying these contrarian investments, which I'll get into our 4-step process next. So the first step, and this approach is applied consistently across the portfolio. There aren't a couple of stocks that kind of snuck in there because of word of mouth, or I have a friend who kind of whispered in my ear and told me about this. We employ this approach consistently, and as long as we do this, our accuracy rate of picking winning stocks is much higher than the average stock in the S&P that has a year that's more positive than the market. So with that, we have an algorithm that I designed to identify stocks with we'll call it a divergence between fundamentals, primarily revenue and margins, because I believe that that's really what the market cares about. I believe that the market doesn't care as much about debt levels, cash flows, things of that nature. If you were to study a stock, you see what makes the market want this stock more or want this stock less. It's very likely driven by changes in the trajectory of revenue growth and sometimes margins, but more so it's going to be growth. And so with that, what we want to do with this screen is to flag interesting stocks that there's a divergence where you have revenues that may be growing and you have a stock that's down 50-60%. That is going to be really interesting to me. I'm going to want to learn more about what's happening here. And so with that kind of like our approach is like a funnel, if you will. You have a broad universe of stocks, and we don't kind of we don't do dumpster diving, if you will, where if a stock is down, we'll go long just to just play the odds. We actually want to filter out and find great companies on the long side, or companies that have really, really, really shaky fundamentals, such that both of them are likely to have a catalyst in the very near future. And so after we identify several stocks that that meet certain criteria, and there are tiers to that where, some situations, look very ideal. They look a lot like our other winners, and other situations that may be interesting that we may want to explore a little bit more. So with that, if it still looks good, we move to level 2. And level 2 is where we focus on gaining, an understanding of the economic ecosystem. We really want to understand outside of the stock market. At this point, we really, kind of pretend that the stock market doesn't exist. We already know what's happened with the stock. We've already done the stock price timeline to see what's driving it. We want to understand, what's going on inside the business, inside of the industry, as if this were a private company. And that helps us to, kind of put blinders up. And so we're looking at all the filings and presentations of the company, direct competitors, industry data and reports, and we're in the information age. So this is a great time to have an approach like this because information is available just, in a lot of magnitude, and you don't even have to pay for a lot of it. Of course, that helps, but, this is the part where we really get some context. And then, if a situation still doesn't make sense, what we're going to do is we're going to move it to level 3. And there are a lot of situations that are, that are killed in level 1 or level 2 because we just don't see clear evidence that the market is going to be proven wrong in the very near future about this company. It doesn't mean that the market's not going to be proven wrong. But, we want to be in situations where, we're rewarded for the deep research that we're going to do. So if a company makes it to level 3, this is where the deep research and analysis is conducted. So we strive to go deep into the story and use rigorous tools to understand the components of the market pricing process, as we call it. So again, with this data that we've gathered, we really take time to analyze it and let the numbers speak to us. So that we can, see, kind of like what story is being told by the numbers, not just the company, but the industry at large. And that's a really key part of our process is to understand the economic ecosystem to which this company operates, because that's going to have that's like the ground that the company walks on, if you will. You can have a lot of confidence in the trends that are happening there. We also conduct interviews with industry participants as much as it's relevant. But again, there's a lot of information available online where people have, kind of blogs and interviews that they've done, to where we can get, relevant information that may be a bit more qualitative. And also we do regressions and other type of time series analysis that really leverages some of my background at Carnegie Mellon to extract more meaning from the data. And we combine that with our understanding of just, the context of this business's strategy. That's really what we want to get after is, what is this business's strategy? How effective has the strategy been? What adjustments have they made to their strategy? And what is the expected effectiveness of the strategy going forward? At this point, if a company makes it all the way through level 3, then we get into level 4, which is where, we actually are going to forecast operations. And that's going to be, what we, rely on, where we actually, will compare our estimates for the company's revenue and earnings growth over the next year, maybe 2 years, depending on where we're at on the calendar, against Wall Street's estimates. And we have to believe that this company will outperform Wall Street's estimates or underperform if we're shorting. And, our accuracy rate on earnings calls is well over 90%. In part, to be honest, the consensus uses the midpoint of management's guidance. And management is usually going to guide a little bit more conservative than not. So if you actually take more of a methodical approach to forecasting, a time series approach to forecasting, you can get a lot of accuracy. And also we do evaluation analysis. And I know I'm going to say some things that are a little bit, not a little bit, a lot unconventional here. And, I, don't have time to really go into detail and speak about this philosophically, but our approach to valuation. We don't believe in DCF. And that's something that's really different compared to the average investor. We don't believe in intrinsic value. We believe that whatever the price the market says it is, that's the price that it is. So, it's less about what do we believe the company's worth. It's way more about what evidence can we find to help us predict what the market will value this company at, given a certain state of the world. And so we like more of a relative approach to valuation, where we look at the company's history from a multiple perspective to see what price tag has the market put on the stock in varying states of the world for this company. So if we see that the average PE is about 30 in times where the market was optimistic, And regardless of, kind of, the trajectory, well, regardless of what the specific earnings number was, that multiple was pretty consistent. That shows that the market has consciously done this. So with that, we take a lot of confidence in that, what the, just this precedent, if you will, that the market is set for valuing this stock, if you will, and that has served us very well. So that's our 4-step research process. And so to move on to our Contrarian case studies, which is, the end of the presentation. I know 30 minutes, flies by, and hopefully you've enjoyed this. Just some examples of the materialization of our strategy. I won't go over, these in detail, but, you can definitely look the stories up and things like that. I've got the research reports on them as well if you're interested. But these are just the situations that we've been able to identify that have done really well for us in these returns, or as of Q2 2021. We have different entry points for when we got into these investments, but as you can see, they're spread across industries, different microeconomic situations, but logically, the stocks and the companies were very similar to each other in that you had great companies, and these are all longs, great companies with stocks that were driven by desire to participate levels that were largely shaped by either fallacies or ignorance or fear, whatever the case may be. But we found the opportunities using our 4-step process, and it's done really well for us. And these are some of the drivers of our great returns, to date. So with that, I would love, to invite you to learn more and to connect. We'd love to build our network now that we're out of stealth mode. And, you can definitely get in touch with me. You can go to our website, pragmaticcap.com. There's a lot of great information there. We definitely have a high transparency process where you can see our research and things like that. We have a distribution list that you can join. And also you can contact me, via email, if you just want to, have a dialogue, ask questions about Pragmatic Capital and just our unconventional approach. So with that, thank you very much for your time. I appreciate it. I hope that you enjoyed it. I hope that you found it informative and engaging. And I look forward to connecting with some of you all in the future. Have a good one.